From following information about security X, calculate call premium by adopting risk neutral method. Spot price of the equity share is rupees 2000. The price of the security may increase to rupees 3000. It may fall down, that is increase to 1000. Time period of option is 1 year. Rate of interest is 25%. Exercise price is 2200. That is the question. So let us have understanding that's how to make the calculation of answer over here. Students, request you to pay attention. First of all, we will have only understanding. Then we will do answer. Only understanding is the point on which we are focusing. See, the spot price of the equity share is 2000. The market price of the equity share may increase to rupees 3000. Or market price of the security may fall to rupees 1000. The exercise price is provided to us, say, as rupees 2200. So we understand that, say, the amount of the payoff that the call option holder is going to get is 800 in the first case and 0 in the second case. Friends, over here, as far as the risk neutral method is concerned, in this method, the premium is calculated, so from option holder point of view. It is calculated from option holder or from option purchaser point of view. From that point of view, so the premium amount is calculated. If at all I purchase option, what I will get? If the price of the security is 3000, I will get 800. If the price of the security is 1000, I will not get anything. Okay. Now what we will do, friends, we will make the computation of the probability for market price of the equity share 3000 and for market price of the equity share rupees 1000. How to make that probability answer? I just explained that within 5 minutes of time. Suppose we have made the computation of the probability of the price of the security going up and probability of the price of the security falling down. And it comes to like this. This is 0.8 and this is 0.2, for example. Now we can conclude something like this. Let's say there are 80% chances we will get payoff of 800. So 80% into 800, so we will get an amount of 640. So to this x variable is assigned. So the probability into x, that is what we understand is the payoff in the first case, expected payoff, and in the second case it is 0. It means that, say, we are going to have the expected payoff 640 and so this is what I am going to get at the end of the year. Now we understand that, so the premium is required to be paid today. As the premium is required to be paid today, so we will make the computation of the premium as expected payoff divided by 1 plus RF. It means that, so the 640 divided by 1.25. That is the way we will make the calculation of the call premium. This is the process that we have for calculation of the call premium under a risk neutral method. So in this method, the premium is calculated from option holder point of view. So whatever the option holder is going to receive in future, will compute the present value of the same as the premium amount. We understand that, so the price is going to be either 3000 or the price is going to be 1000. Like that, so there will be one of the two prices that we will have. Now what is the probability for individual price will be calculated. How to make the computation of the probability, I explained that to you after 5 minutes. We understand that, when the price increases, then the payoff is positive. When the price is falling down, the payoff is 0. Why? Because the spot is less than exercise price. So there are 80% chances you will get 800 and there are 20% chances you will not get anything. So probability into payoff, in that way we will make the computation of expected payoff. The term expected payoff stands for, so the amount that we are going to receive at the end of the period. Simply, we will compute the present value of the same. Present value of the expected payoff is, so the premium that we are ready to pay today. This is the process that we have. Now friends, over here, the concept is like this. See, the price of the equity share may increase, the price of the equity share may fall down. So the price of the security may, that is change in either of the direction. However, we are having a kind of conclusion over here, or the kind of theory that we have, that the spot price of the security will give at least the return equal to the RF. So what will be the expected spot price? It is similar to what we compute as a forward price, that is spot plus interest. What is the spot price of the security? Spot price of the security is an amount of 2000 plus 2000 into 25% for 1 year. So what will happen? It is 2500. That is the way working out number 1 is the expected spot price of equity share. Afterwards, listen carefully. Probability, market price of the share to which x variable is assigned. Probability into market price of the share. The price is going to be either 3000 or 1000. I assign p variable for the price increase. So what will happen automatically? 1 minus p is the probability of the price increase. 3000 into p, it is 3000p. And 1000 into 1 minus p, that is 1000 minus 1000p. Now, based on that, so we will have the expected price, and the expected price is 2,500. Because we understand that the price will be either 3,000 or 1,000. Between both of them, the probability distribution will be such so that the expected price will be equal to like the forward price. This is the expected price. Accordingly, we will make the calculation of P. Suppose the value of the P is 0.8, then how to do further answer? That already I have explained to you. Return answer. So return further answer. Return further answer. 3,000 P plus 1,000 minus 1,000 P is equal to 2,500. So 3 minus 1, that is 2,000 P is equal to 2,500 minus 1,000. So P is equal to 1,500 divided by 2,000. That comes to 0.75. So there are 75% chances that the price will go up and 25% the price will fall down, and accordingly we will make the calculation of the premium. Step number 2. Calculation of call premium. In the relevant answer, probability, market price of the share, payoff. We'll assign X variable to payoff. Probability into X. The price of equity share will be either 3,000 or 1,000. There are 75% chances the price will increase and 25% chances the price will fall down. If the price increases, the payoff is 800. That is 3,000 minus 2,200. In the second case, the payoff is 0. There are 75% chances that you will have the payoff of 800, and there are 25% chances the payoff is 0. So what is expected payoff? 600. Whatever the expected payoff that we have, we'll convert that into present value term, and that is the call premium. Return answer, call premium. It is expected payoff divided by 1 plus gain. So it is 600 divided by 1.25. That comes to rupees 480. That is the way the call premium can be found. Now there is a question that, sir, why we have taken over here 2,500? I give explanation of the same. We understand that generally, when I make investment in the security, then in that case I am expecting the security to give return at least equal to the risk-free rate of return, if not anything more. So we understand and say we are expecting that the price of the security will have at least the appreciation to 2,500. At the same time, we have been given that we are expecting the price of the security to be either 3,000 or 1,000. So we have to understand that between both of them, the probability would be say bifurcated in such a way so that the expected price will be equal to the price at which you will get at least the return equal to RF, that is 25% over here. So let us heading alternative method to compute P. Now friends, in order to compute the probability of the price increase, there is an alternative method too. What is that alternative method that I am discussing with you? It can be computed like this. P is equal to 1 plus RF minus D upon S divided by U minus D upon S. That is the way, say we are required to. So 1 plus RF, what is the risk-free rate of return? It is 25%. Minus D upon S, the price of the security may fall down to 1,000 from the current price of 2,000. Whole divided by up price, the price of the security may increase to 3,000. Minus down price 1,000. Whole divided by 2,000. So what will happen it is 1.25 minus 1,000 divided by 2,000, that is 0.50, divided by 2,000 divided by 2,000, that comes to 1. So it is 0.75. You may write down this answer. There is yet one more method is here. Then on alternative method. The reason that I am dictating to you is this because sometimes you may find this kind of formula and you are surprised that say from where the formula comes. So alternative method is like this. Then on spot into 1 plus RF minus down price whole divided by up price minus down price. So what is the spot price of the equity share? It is an amount of 2000. What is the rate of interest? It is 25%. Minus down price. The price of the security may fall down to rupees 1000 divided by U minus D. U is 3000. D is 1000. So it is 2500 minus 1000 whole divided by 2000. So 1500 divided by 2000. That comes to 0.75. So the return answer. And further one more method is there. Alternative method. It is like this. Return answer, I will explain that to you. Risk-free rate of return is equal to probability of price increase into percentage of price increase plus 1 minus P, that is probability of the price decrease into percentage of price decrease. This is the formula that we have. So RF is 0.25. P is the probability of the price increase into percentage of the price increase. So it is 3000 minus 2000 divided by 2000 plus 1 minus P into 1000 minus 2000 whole divided by 2000. So 0.25 is equal to, see what will happen friends, we understand that this is 1000 divided by 2000 is 0.5. So 0.50 into P plus, this is again 0.5 but this is negative. So plus 1 minus P into negative 0.5. Okay. So 0.25 is equal to 0.50 P plus, this is 0.5 negative into 1 positive. So it will be negative. So here it is negative 0.50. This is negative 0.5 and this is negative P. So negative will become positive. So plus 0.50 P. Now this is transferred over here. So from negative it will become positive. So it will be 0.75 is equal to 0.50 plus 0.50. So 0.5 plus 0.5 is 1. That is P. So P will be 0.75. Return answer.